in New York. You can only play the game for so long. When people have to order, they have to order. Well, there's no doubt about that. When people don't order, there's a pinned-up demand out there. Growth in the U.S. will probably keep orders flowing into factories in the coming months. The economy expanded in the third quarter at a 5% annualized pace, the fastest since the 3 months ended in September of 2003. And according to data from the Department of Commerce, consumer spending, which accounts for 70% of the economy, grew at 3.2%. And also here we have hiring and cheaper gas are driving U.S. purchases. Car makers are amongst the manufacturers poised to keep benefiting. U.S. car sales rose to an amortized pace of 7.1 million in November from 16.4 million in October. That's according to Ward's Automotive Group. By measure, households are reaping significant disposable income gains each week at the current gas price. That is from Emily Morris at the Ford Motor Company. Chief economist told an analyst on a call in early December. At the same time, cooling overseas markets hurt some U.S. producers. The European Central Bank officials meet on the January 22nd to consider steps to drive down borrowing costs and revive Europe's economies. China is on a course for slower growth since 1990, as according to Bloomberg. Of course, the Russian Federation, a big exporter, is facing its first recession since 2009. Well, that is obviously to be expected. The Russian Federation obviously will have to forge ahead and prepare for that eventuality, which is an eventuality. There, no doubt about that. Let's see if there was one other item we wanted to grab from Bloomberg. Here, we'll get the bull market here. We don't do a lot of market. All the Federal Reserve and the expanding economy set tone for stocks in 2014. The Standard & Poor's index rallied to an unprecedented highs and extended the bull market rally past 2,000%. The S&P 500 closed 53 times at a record. The Dow Industrial Average climbed more than 18,000 as accelerated growth fueled optimism in the economy. Accommodative central bank sent risk-seeking investors into equities. Energy shares, of course, tumbled. Airline stocks soared there as they adjust. So again, you see the energy prices. You've seen various commentaries on the Obama administration, their role in falling petrol prices, attempts to stymie OPEC. Well, one of the situations there's no doubt it has caused economic downturns and recessions in the Russian Federation, also in Venezuela. But at the same time, as economies adjust to the downturns, there are some corrections within those economies. The Russian Federation is moving to correct some of the problems there. And of course, one of the problems they had from the very beginning was an over-reliance on fossil fuel sector to fuel their economy. So they're going to have to do some retooling. The same thing in Venezuela. Comandante Mundros, the presidente there, has talked about redoing some of the Venezuelan economy. And now also doing this move, they are basically selling petrol at bargain basement prices, basically 2-for-1 sales, and signing more long-term contracts. So what they're trying to achieve in their fossil fuel-driven economies is the same type of stability that is starting to take place in the U.S. through the 70% consumer plunge. Now, That basically means that consumers have more disposable income, but they don't have a lot of disposable income. So thus, things tend to moderate. If you recall, during the holiday season, there were a number of days were targeted by retailers, and of course those days were the days. After those days, things sort of cooled off, as one would say. It was not hot coals out there. So you've seen a different situation occurring there. So that's one of the things to look out for there. Let me finish with this Bloomberg thing. After last year's 30% rally in the S&P 500, it is tremendous to be somewhat up in the double digits at there. That is from the Philadelphia Trust Company, which oversees $2 billion. Their stock investors should be very happy about having a follow-through like this, and there's optimism about the economy, lower gas prices as far as consumer confidence. Consumer confidence does tend to be more optimistic if what they see is more optimistic, and that is where the larger media plays into it. You have the business financial shows that some people watch, and you have to understand there's a small percentage of the American people that actually engage in the market, quote unquote. But many watch the commoditized news, economic shows that segments that are on, say, the cable stations, etc., and what commentaries they have. A lot of networks have curtailed their economic reporting and just basically put that to MSNBC, the financial channels. Fox News does a little bit of it. We still have the nightly business report, etc. Nonetheless, the S&P rose 11% to 2,058,90 after gaining in 2013 by the most since 1997, while the S&P 500 index rose 1%, lost 1% on the 31st, left the index down 0.4%. Dow added 7.5% to 17,823.2, slipping 18,000 the final few days of trading. The Russell 500, we used to do that all the time. The smaller companies climbed 3.5, while the NASDAQ Composite Index advanced 13%. The European shares advanced a third year, while the Chinese equities had the best performance since 2009. West Texas Intermediate crude entered a bear market as futures tumbled to the lowest since 2009. The Bloomberg Dollar Spot Index climbed 11% for its best performance in data going back to 2005, and Treasuries returned the most in 3 years. Obstacles ranging from violence in the Ukraine, Ebola, and those kinds of things. But those are only sort of cosmetic situations. The central bank pledged patience in raising interest rates, while data shows the economy expanded the most in the third quarter since 2013's Americans. Employers hired more people in November than at any time in 3 years. Consumers lower there, fell to $53 there. So those are some of the things that are a little bit anecdotal here. 4 consecutive year turbulence abide in the American equity market. Chicago options exchange volatility index averaged 14.7% over 250 market days. That's down from 14.23 in 2013. So a little bit of going on there. The S&P in the emerging shares, the MCCI All Country World Index, excluding the U.S., shrunk 6.3%. The emerging market index slid 4.6% as the Russian mix index lost 7.2%. You could expect that to happen. Bonds and commodities, the Bloomberg Commodities Index, a lot of these things coming out here. BCOM plunged 17% for the fourth straight slide. Copper capped the biggest annual loss there. Gold futures fell 1.5% at $1,184 for an ounce of first back-to-back decline since 1998. The airline index, this is Bloomberg's here, benefited from drop in petrol, surging 38% in the fourth quarter. Southwest Airlines posted the largest advance in the S&P 500 this year, soaring 125%, while Delta Airline climbed 78%. American Airline Inc. Led the NASDAQ 100 index at 112%. Oil drillers have been on the other side of the run, with a gauge of S&P producers slipping 14% in 2014. 33 out of 38 companies in index of Rex Energy Corp plunged 74%. For the biggest loss, Transocean shrunk 63%. For the worst performance there. Utilities, IBM, utility stocks gained in 2014 at 24%. Healthcare companies, which posted the second largest gain, in spite of what some people said, at 23%, saw 4 times as much market value created due to their larger weight. Technology companies had some of the biggest gains on the Dow. Intel rising 40%, Microsoft jumping 24%. Consumer shares such as Office Depot, Walt Disney, Nike also rose 22% and led 33 stock gauges. Advanced international business, IBM, was the worst performer for the second straight year with a slump of 14%. The Russell 2000, let me get back to it here. Somewhere here we had, it wasn't all smooth yet. The small caps, Russell 2000, lost 2.8% over a 3-day period starting July 15th, after the Fed expressed a concern about valuations amongst social media and biotech companies. This is some of the kind of, I guess you'd say, basic information here. So we'll leave it, and we'll go to the people at Market Financials and grab some of this information as we run a little bit. This is the U.S. Manufacturing PMI here, and this is the final data, and we'll run to it very, very quickly here. The summary, December's data signal a future solid expansion, a further solid expansion of manufacturing production along a rising level of employment and incoming new business. However, the final season adjusted market purchase managed index fell to 54.4% in November to 53.9% in December. As a result, the latest figures indicate the weakest improvement in the overall manufacturing sector business conditions since January. That would be 2014. Although the latest survey points to a solid rise in manufacturing output, the rate of expansion eased in for the 4th month running. At least March since that anecdotal evidence suggests that uncertainty towards a global economic outlook has contributed to a slower pace there. But that will normalize over time. Levels of new work continue to increase. In December, the rate of expansion picked up slightly from the 10-month low recorded during November. Meanwhile, new export orders returned to growth by the end of 2014, but the upturn was only moderate and weaker than seen overall new orders. The number of manufacturers noted weaker demand from the Euro area and emerging markets, which contrasted with relatively strong spending patterns among domestic clients, as in the U.S. But the U.S. economy has always been an economy that is somewhat exceptional. Now, we're not talking about American exceptionalism here. What we are talking about is because of the dependence of 70% on the consumer in the U.S., that does isolate much of the economy from other parts. Large manufacturers, that's the ones that employ over 500 workers, continued to outperform small and medium-sized manufacturers in terms of output and new